Hello there and happy Tuesday to you. Welcome to the April 5th edition of the weekly market update. I am your host, Sean Richard, here with SRT Live. And today we are talking about all things real estate related, mortgage related. Going to update you what's going on in the market and what we can expect heading forward. So let's dive right in. So today we actually got CoreLogic's home price index. Now, let's talk for just a moment on CoreLogic. CoreLogic has historically been off the mark on their appreciation forecast. Last year, about this time, CoreLogic was forecasting an annual appreciation of about 3.2%. Well, we ended up last year just north of 19% appreciation. So they were a smidge off. So they're forecasting another relatively low appreciation year. But if we look at the reports for the month of February that we just got today, 2.2% appreciation in home value, home price increase. And so already off of the mark that they're setting. Year over year, CoreLogic is showing a 20% appreciation, which is actually a record for them. So really, really big numbers in appreciation. And that goes to, that speaks to the supply demand dynamic that we've got, very low supply, high demand. You've heard me talk about that before. So home prices still going up at a rapid pace. Looking at last week's information, we had a pretty packed week last week when it came to numbers. On Friday, we got the national jobs report from the Board of Labor, or the U.S. Board of Labor and Statistics, showing that 431,000 jobs were created for the month of March. Now, the market was expecting 490,000. So a little bit of a miss there, but the unemployment rate still ticked down from 3.8% to 3.6%. And part of that is because January's job numbers were revised higher. And so although it was a miss for the month of February, there was a positive revision for January, which softened that blow a little bit. Now, flipping to unemployment claims, we got initial and continuing, as we do every Thursday. Those numbers staying relatively low. The previous week, we were down at around 187,000. This past Thursday, we got 202,000 with the expectation of 197. So pretty close to on the mark there. And as far as continuing claims, people who are renewing their unemployment claims, we came in at 1.30 million versus the 1.35 million expected. So staying very, very low, near post-pandemic lows for unemployment claims. So as you've heard me talk about in the past on previous broadcasts, the labor market staying really, really strong. We also got PCE last week, which is personal consumption expenditure. This is the Fed's favorite measure of inflation. Now, it doesn't take into consideration housing, and that can be a pretty big piece of the pie because of the rapid increase in housing costs right now. PCE doesn't necessarily reflect true inflationary costs since it's not taking into consideration housing. However, it's the Fed's favorite, so we keep an eye on it. So this is for the month of February. This lags a couple of months. So month over month, the market was expecting a 0.5% increase. We actually got a 0.6% increase month over month, and that was right in line with what we got the month before. Year over year, however, the market was expecting a 6.7% increase, and we got 6.4%. So you would think that means that, okay, well, maybe inflation is coming down a little bit, but again, this doesn't take into consideration housing. So next week, we're going to be getting PCI, which is Consumer Price Index. And I've talked a lot about this. That's coming out next week, and that's going to give us another great inflationary reading to figure out exactly where inflation is at. Are we still rising? Are we plateauing? Or have we peaked and we're starting to come down? And we'll know more about that next week. All right, so looking ahead this week, relatively low-key week, although on tomorrow we are getting the Fed minutes from their most recent meeting. And this really just gives us a more granular view into what the Fed is thinking. And this is usually a market moving data when we get these Fed minutes. So keep an eye out for that. And then, as always, on Thursdays, we get jobless claims, both initial and continuing. So that's coming out this week as well. So what are we focused on this week? What is important to watch? One, the Fed minutes coming out. We want to see what their thoughts are about their monetary policy, how quickly or slowly they're going to address inflation. So that's going to be really important. Separately, we're also hearing from some Fed members this week. We actually heard from Lael Brainard today, and Lael was advocating a balance sheet, a faster balance sheet runoff, a more aggressive balance sheet runoff. Now, I've explained this in great detail previously, so I won't go into too much detail today, but essentially, the Fed has been buying up mortgage-backed securities and treasuries. And so if the Fed starts to sell off their balance sheet, start selling these mortgage-backed securities, that's likely going to pressure interest rates higher. So even though the Fed is looking at increasing the Fed funds rate to curb inflation, which would help interest rates, if they start to reduce their balance sheet, that could have the exact opposite effect. So we need to keep a really close eye on what they elect to do. Now, because Lael Brainard came out and said that that she believes that there should be a more aggressive balance sheet runoff, we've seen mortgage-backed securities plummet today, to be honest with you. So let me pull this up so that you can see this. So here we are, mortgage-backed securities down 87 basis points on the day. We started the day down about 30 basis points. And once Lael Brainard came out and mentioned aggressive balance sheet runoff, we lost another 50 basis points or so. So you can see here, we have just been kind of in a tailspin for a while. And today we've got this big red candle. So we are seeing mortgage rates rise a little bit today. Hopefully we can rebound in the coming days, the rest of this week, but we'll see where we end up at the week on that. Hopefully an overreaction by the market today and we can rebound. And then the other item that we want to keep an eye on is the yield spread. And again, this is the spread in yield between, the main one is the 10-year treasury and the 2-year treasury. Typically, the 10-year should yield higher return than the 2-year because you're taking risk to lock your money up longer. And that yield curve, that yield spread has inverted lately. The 2-year has been higher than the 10-year for periods over the last week. And that is typically a big indicator of a future recession. And with information moving so much faster than it has in decades past, the normal time frame between when an inversion happens and when we see a recession is upwards of 18 months. With information at the speed that it's at today, we could see that happen a little bit faster than that. So we want to keep an eye on any slowing in the economy. As a reminder, a recession is technically classified as 2 consecutive quarters of negative GDP. So if you want to go look up GDP and keep an eye on that, that will help you stay in tune there. So those are the 3 big things that we're looking at for the near future. The Fed minutes, unfortunately, the Fed speakers coming out and giving the market some direction, and then watching that yield spread to see if we continue to stay inverted or if we come back positive. So other than that, if you have any questions, you want to talk a little bit more about the market, or you want to understand how you can help your clients better navigate the market, please don't hesitate to reach out to me and my team. You've got my number right here. Comment on the post, and I'll be happy to get back to you as well. But thanks so much for tuning in to SRT Live this week. Have an incredible rest of your week, and I'll be back next Tuesday with another market update. Take care. Well, looks like if you're still here, my mouse died and I can't shut off the broadcast. So we're going to try this again in just a minute. Hang tight. Thanks for sticking around if you're still here. All right.